ball at you guys, if that's okay with you. Now, one of my biggest pet peeves in the entire world is when people, and now keep in mind, this is Bed Bath and Beyond, when people are buying options that are like way out of the money. Okay? Look at the gamma that they're going ahead and they're forcing. It's pretty much non existent. And then as you get closer, right, you see the difference in the gamma. Now, the gamma is going to help. The gamma is going to help, obviously with the pressure to the upside, to the downside, depending on whether it's call, whether it's a put. However, keep in mind that this week is it's an OPEX week. Okay, it's a witching day. All right. I typically like to buy options. If I do buy options, like near witching days, I like to buy them the week after, just to give myself some time. And it's worked. It's worked a few times on AMC and GameStop. I will say that. Okay. Um, we are going to dive in here. Hold on. So delta hedging. So, delta hedging is an option strategy that aims to reduce or hedge the directional risk associated with price movements in the underlying asset. We see institutions do this all of the time. All of the time. You just have to watch the options flow, right? And you'll see them slowly come in, slowly come out, and by doing that, it kind of mitigates whether the price is going to go up, whether it's going to go down, and that's why I constantly say to watch the options flow. Um, I'm just gonna give like small breakdowns of this, but Investopedia is basically my Bible. So please come to Investopedia, and if you have like further questions, please go ahead and just search. It's literally a wealth of knowledge that like we honestly don't even deserve, right? This is how I taught myself everything finance. Okay, gamma and how is it used? It's an options risk metric that describes the rate of change in an options delta per 1 point move in an underlying asset's price. Delta is how much an options premium price will change given a 1 point move in the underlying asset's price. Therefore, gamma is a measure of how the rate of change of an options price will change with fluctuations in the underlying price. The higher the gamma, the more volatile the price of the option will be. That's why I'm constantly looking at open interest, and I'm looking at the gamma levels of the open interest. Okay, Vega, if it'll load. Okay, Vega is the measurement of an option's price sensitivity to changes in volatility. Okay, so say that you have a metric F ton of BBBYs, and all of a sudden they slide into the money, right? Your Vega is probably going to be pretty high on options like that, just because like it doesn't move all that much. Okay, in general it doesn't move all that much, but if it does, then it could get crazy very quickly. That's one way that I could think of it, or that I could try to explain it. Again, come here for a more in depth description. Theta is going to be your time. Okay, so the longer that I'm not even going to click on one of these. So theta is going to be your time. Okay, when you're buying an option, if you buy say a week out, 2 weeks out, 3 weeks out, whatever, right? That's going to be the longer you're paying for theta. Okay, the worst thing to happen, in my opinion, is let's say last week the BBBY ones were, or the 150s, what did they close at, like 140 or something like that? So obviously you didn't hit on them. However, if BBBY is moving up and you have 1.5s for this week, yeah, you paid for the theta, but now you might actually hit on them. So it's kind of like just a risk reward kind of setup. IV, implied volatility. The term implied volatility refers to a metric that captures the market's view of a likelihood of change in a given security's price. Investors can use IV to project future moves in supply and demand, and often employ it to price options contracts. IV isn't the same as historical volatility, also known as realized volatility or statistical volatility. So, let me show you. Just because I don't want there to be any type of confusion. Okay, so Look at the IV on. All right, so again, we're gonna go to BBBY. Okay, look at the IV. Now I know that the market didn't open yet. Okay, look at the IVs on these. Like we're talking like 200 for the 1.5s. Huh. It's trading at what 140 right now, and it already has an IV of 222. Now let's do something like, let's see, what wouldn't have that much IV? Let's see. I'm sure that's gonna have IV. Let's just go to Coinbase real quick. Or maybe Snapchat might have low IV. All right, look at the IV difference. See the IV? It's literally half as much compared to what BBBBY's is. Do you see what I mean? And that's that's the at the money strikes. Oh, and let's go here. Now here, right here, other than just buying like straight up calls or like if I'm selling covered calls, whatever, right? My favorite strategies are going to be straddles and strangles. Now the reason behind this is because straddles and strangles, they may go ahead and they may cut your obviously your profitability a little bit, but they save you on the downside. Okay, so a straddle, what a straddle is going to be is a straddle is going to be going ahead and that's going to be buying the same exact strike, whether it be a call or a put, right? I'm sorry, you buy both, and then you just cut your loser, and then you let your runner run. Okay, but it protects you to both sides. Now, a strangle is going to be a little bit different. There's going to be a little bit of room in there, right? Where say the put is at, I don't know, maybe like let's say $5, right? But then let's just say that the call is at, I don't know, maybe $7, right? You do not want it to land in between the 5 to 7 range, right? It just doesn't make sense. Now, sometimes you could get lucky. I've done it several times where you get to hit on both sides of it, and that's money. If you could hit on both sides of a straddle or a strangle, then you are doing pretty dang well for yourself, in my humble opinion. Okay? However, please come to Investopedia, search all of the option Greeks, search different strategies, paper trade, do all that kind of stuff. And then when you're looking at options in specific, right, make sure that you're paying attention to the strike price, because the last thing you want to see is a shit ton of strike prices that are just way out there that have no chance of actually affecting the price movement. But what I'm referring to, look at these. See the open interest? Now remember, you have to times everything by 100 when it comes to options for the most part, okay? So let's just say that it goes to 55 on Coinbase, okay? That's going to mean that, 500,000 shares go into the money? You see what I'm saying? Full 500 and, obviously change. So just pay attention to that, and then obviously you're going to read your Greeks. And then also volume here. I find volume very important because this helps you tell how much, how many options are being purchased on that given day. All right. Yeah, just pay attention to flow, guys. That's all I got for you. Best of luck to everybody. I'm going to go ahead and I'm going to clip that. Come hang out in live, though, guys. Feel free to ask questions, all that cool stuff. We're about to make some money today. Later, guys.